Looks like inflation worries are starting to come back because yesterday we got a new inflation report which came in hotter than expected, and then right after that we got a new job market report which came in worse than expected. Now, while this news didn't directly affect the stock market immediately, it did impact the bond market because we saw bond yields jump, which led to the biggest jump in mortgage rates since April of this year. So what I want to do in this video is go over number one, what does this mean for inflation and potentially stagflation? Number two, what does this mean for the job market? And number three, how does this affect you? Starting with inflation, let's go over the CPI numbers. The CPI inflation numbers, the headline inflation came in at 2.4%, which is a little bit of a mixed number because it's lower than where we were last month. But the reason why people were kind of surprised was because the CPI number came in higher than what economists were hoping for. But if we take a look at core inflation, remember core inflation is what the Federal Reserve Bank prefers to look at. Core inflation is when you take the headline CPI number and then you strip out what's known as the volatile numbers, the energy and the food. Core inflation came in at 3.3%. Why is that significant? Because not only is it hotter than where we were last month, but it's also hotter than what economists were expecting. Now remember, the Federal Reserve Bank has set an inflation target for 2%, and we are not there. And the reason why this matters is because now the Federal Reserve Bank has just begun cutting interest rates, and we also got news just a couple of days ago that all Federal Reserve Bank officials are not in support of big Federal Reserve Bank rate cuts. Earlier this week, we got the Federal Reserve Bank minutes, where we got the news which show that there was a substantial majority of Fed officials who favored the larger rate cut, but we had some Fed officials who wanted a smaller rate cut because they're worried about a resurgence in inflation. Now here we are with the newest inflation data, which came in a little bit hotter than expected, which will be interesting as to what this means for the Federal Reserve Bank in the next meeting in the first week of November. Of course, we're going to be keeping you updated here at Market Briefs. Market Briefs is my free financial newsletter where every day my team is breaking down what's happening in things like the economy, the stock market, the housing market, the crypto market, and the global economy into a fun, witty, and easy to read newsletter. If you have not joined Market Briefs yet, well, what are you waiting for? It's completely free. I got the link for you to join down in the description below. Now, if we switch gears a little bit, let's talk about what happened in the job market. Because on top of this higher than expected inflation report, we also got a new jobless report, which said that new jobless claims came in hotter than expected. And this was the hottest new jobless claims report since August of 2023. Now, if you remember, about a week ago, we got a new unemployment report, which said that unemployment fell to 4.1%. And this got everybody excited because they were talking about how strong the job market is with unemployment falling faster than expected. Now here we are getting a new jobless claims report where jobless claims are coming in significantly worse than expected. And you might be wondering what is going on. So let me break this down. Jobless claims are a weekly number of people that file for unemployment. So this is right now, this is how many people lost their job and are filing for unemployment. Unemployment is a broader term for people that are collecting unemployment checks and do not have a job. And so it's not good news to see it jump in jobless claims because that will then trickle into the unemployment numbers, assuming those people don't get a job. But that's the distinction between those two numbers. Now, why does this matter? Because the Federal Reserve Bank has been pointing at a strong job market as the reason and ammunition for them to also cut interest rates. The Federal Reserve Bank has been saying that inflation is on a downward trajectory. And while inflation is on a downward trajectory, while the job market is getting worse, the Federal Reserve Bank needs to stimulate the job market. But then what we saw happen up until very recently is we saw the job market get stronger and stronger. Unemployment numbers were falling. Unemployment fell from 4.3% to 4.2% to 4.1%, which meant the Federal Reserve Bank was stimulating or started stimulating, but the job market was getting stronger while inflation was also falling. So why did the Federal Reserve Bank need to keep cutting interest rates? Now we're starting to see a little bit of a conundrum. On one hand, the inflation numbers aren't falling as fast as the Federal Reserve Bank would like. The core inflation numbers actually rose, while the job market, or at least these initial jobless claims, came in a little bit worse than expected. This is why we're starting to see more news or headlines that came in about people worried about stagflation, and why we saw the job or bond market rise. So let me go into part 3 of this video, which is how does this affect you? Now, starting with what is stagflation, because you might start to see more headlines about this. Let's make sure we're very clear about this. Stagflation is where you see a few things happening. Number one, you see a rise in unemployment with a rise in inflation while a slowdown in the economy. It's kind of the worst case situation because in a stagflation economy, that means things are getting more expensive while the economy is getting worse. Things are getting more expensive while people are losing their jobs. That's what stagflation is, and that's what you want to avoid. And that happens when you continue to have these inflation worries and concerns about your currency. And this is what the Federal Reserve Bank says is not even in the realm of possibilities. But anytime you see reports of inflation rising or coming in hotter than expected while unemployment is getting worse, people start to get worried about stagflation. That's why people are worried about that. That's why you've probably seen more headlines about that. But that's what's going on with that. On the second point of this, on the inflation side, remember, the Federal Reserve Bank wants to see 2% inflation, and the number one hot thing, the sticky point in inflation is still shelter costs. That's housing costs, rent costs. And the reason why this is significant is because the Federal Reserve Bank is working to cut interest rates. Now, we know that mortgage rates are impacted by interest rates that the Federal Reserve Bank sets. And so if we start cutting interest rates, and if you're aggressive with interest rate cuts, what is that going to impact? It's going to impact mortgage rates. And we know that mortgage rates have a direct impact on home prices. Why? Because as mortgage rates go down, people are willing to bid more money to buy a home. And so when the concern for inflation is housing prices and rental costs, and you start cutting interest rates, that could have more impact on housing prices. And now, it's still a little too early to see what the most recent Federal Reserve Bank interest rate cut is going to do on house prices. This is something you want to pay attention to because we have heard time and time again that the Federal Reserve Bank wants to cut interest rates again in 2024. They want to cut it multiple times in 2025, and they want to continue cutting interest rates in 2026. And so if inflation continues to stay a concern, and the Federal Reserve Bank continues to cut interest rates, and the job market continues to kind of fluctuate, that's going to have some very interesting consequences in the economy. And this is why now all eyes are on the Federal Reserve Bank. Because even yesterday, we had a lot of people talking about how, what is this going to mean for the Federal Reserve Bank and future interest rate cuts? Because you have a lot of companies that are relying on the Federal Reserve Bank to cut interest rates to stay in business and to continue growing their sales. What do I mean? Home Depot and Lowe's, for example, have talked about how they are waiting for the Federal Reserve Bank to cut interest rates more aggressively because you have a lot of homeowners that are waiting to do their home remodels until they can qualify for a cheaper home equity line of credit. You have a lot of mortgage lenders and realtors that are pushing the Federal Reserve Bank to cut interest rates. That way more people want to go out and sell their homes. That way more people want to go out and buy new homes because when mortgage rates fall lower, somebody who has a 3 or 4% mortgage rate locked in will be more likely to sell their home because going from a 3 or 4% mortgage to a 5% mortgage is less steep and less worrisome than going from a 3 to 4% mortgage to a 6, 7, or 8% mortgage. That's why that's why realtors and mortgage bankers are hoping that the Fed will start cutting interest rates sooner rather than later. Not to mention the fact that if you are a buyer, lower mortgage rates could make your mortgage cost more affordable, assuming you don't have to borrow too many more dollars. The question is, how many more dollars would you borrow? But if you borrow more dollars, that also means that the mortgage banker and the realtor get a bigger commission check. So they also benefit when you get these lower interest rates. Not to mention, you have a whole lot of corporations that are sitting on tons of debt. You have a lot of commercial landlords that are sitting on trillions of dollars of debt that are starting to readjust in 2024, that will readjust even more in 2025. And so they're hoping and praying that the Federal Reserve Bank will continue to be aggressive with their interest rate cuts because that will make their debt servicing costs cheaper. Remember, these commercial landlords and corporations don't have a 30-year fixed rate mortgage. They have readjusting debts. And so these debts are starting to come due this year. More will come due next year. And so they're keeping their eye on what the Federal Reserve Bank will do because that's going to impact what their expenses are going to look like in their company. Because if your expenses are rising and you're not seeing growing sales, because we know that it's tougher to keep growing sales during a time where wages are not keeping up with inflation, that could create more issues for these companies. That's why all this stuff matters, and that's why, again, we go back to what does this mean for you? You want to be a financially savvy and a financially educated investor. That means, number one, be financially prepared no matter what. It doesn't matter what's happening in the economy. I don't care when you look at what's happening in the economy. There's always crazy things happening in the economy. That's how the economy works. Be prepared. have a savings cushion. Have 3 to 12 months worth of cash put aside to protect you against an emergency, pay off your credit card debt, and then have cash to invest. Once you get past that, that's when you start investing in your financial education. Start learning about how do you analyze stocks, how do you analyze ETFs and index funds. Start to analyze what it is that you want to invest in. Maybe you want to invest in real estate, learn how to underwrite real estate deals. And that's when you start digging into financial trends. Where is it do you want to invest? What type of industries do you want to invest in? Where do you see the money moving to? This is the research that you want to be doing as a financially savvy investor. That way you can take advantage of opportunities when they come your way, because the reality is there's uncertainty in the markets. That's always been there. And it looks like there will be more uncertainty, especially now with inflation as a concern, with the unemployment market as a concern, with the election as a concern. Uncertainty is not good for the markets, but it creates opportunities for a financially savvy investor. And I want you to be one of those financially savvy investors that can take advantage of shifts that happen in the market. Now, again, we'll be keeping you posted on market briefs. If you haven't joined yet, I got the link for you down in the description. And I'll be doing my best to keep you updated here as well.